Well, the joke is not a new one, but it's certainly a good one. How do we know that economists have a sense of humour? They put decimal points in their forecasts, and we saw the economy ended 2018 in slightly worse shape than some market commentators had expected. We saw GDP growing by a further 1.4% quarter on quarter, that's seasonally adjusted and annualized. But if you look at where we were on an annual basis, I think many were penciling in growth of 0.6 or 0.7, and we came in at 0.8, so a slight beat there. But I think the bottom line is clearly decimal points. They're not enough. We need to see signs that we're at least heading in the right direction. And have we seen enough from that print? Well, let's welcome tonight's panelists to give us the good, the bad and the ugly. Citadel's chief economist Maarten Ackerman joins us in studio. Now on the line we also have Bonang Mahale, CEO of Business Leadership South Africa, and Kevin Lings, chief economist at Stanlib. Maarten, the Bloomberg consensus, as I said, was for annual growth of 0.6. We had National Treasury and the SARB looking at 0.7, so 0.8. Woohoo! We got an extra tenth of a percent there. But the fact remains that we're getting excited over decimal points. What is the good in all of this?
Yeah, good evening. I think you're 100% right that the numbers are still very weak. And if you compare that to population growth, per capita we're still getting poorer. Per capita we're actually still in a recession. So that's looking at the glass half empty. If you want to look at the glass half full, then one can argue to say, well, we are leaving the recession behind, which was part of the first two quarters of 2018. And yes, the number for the year is not great. But if we can continue on the strength, and if we can look at where the underlying sectors that are making a contribution, where that is, then I think there is some positives in the pipeline going forward. It's great to see manufacturing playing a bigger role. That's one of the sectors we need to get going to actually create jobs. Transport and agriculture. So there's also underlying some good, even if that number 0.8 is still quite low and quite weak.
Manufacturing is a very good sign because the World Bank have demonstrated that it's probably the highest in terms of returns when it comes to job creation in the South African economy. Bonang, today's GDP figures do confirm, though, that growth is subdued at best, and the underlying conditions are challenging. The confidence that we're trying to rebuild is quite fragile. I believe the line has just dropped there. So, Kevin, I'm going to toss this one your way. I guess you've got to now sum up the bad. If Maarten tried to give us the good, and that is the manufacturing silver lining, what's the bad?
The bad is that you're not getting growth across a broader range of sectors. If you look at the performance in the fourth quarter compared with the third quarter, there are a number of sectors that are having positive contribution, then negative contribution. In other words, not delivering a consistent improvement in growth over a period of time. For me, particularly the trade sector, retail, wholesale trade, that's really where the consumer is. It's obviously a big part of this economy. We had, if you break down the retail sales, we had a great November last year because of Black Friday. And then when it rolled on to the December numbers, it came off very sharply. And you see that in the overall performance. So I would say that was disappointing. And clearly, we're just not adding jobs, and the consumer, I would suspect, is under significant strain. And then the sectors that you would hope in a country like South Africa are more prosperous, things like construction. If I look at the last 8 or 9 quarters, they've had one positive quarter in the last, I think, 9 quarters. So that's really difficult. And obviously we're going to get the growth rate up to where we need to create jobs. Then construction has to play a bigger role. So my concern is you're just not having a broadening out of the growth dynamic in South Africa. It's really one or two sectors, with manufacturing kind of being the standout right now.
And Kevin, you produced an excellent document after the budget showing the compound annual growth rate of South Africa's social grant beneficiary numbers. Just under 3 million back in 2000. 2018 it stood at 17.6, forecast to 17.9 and 18.2 in 19 and 20. compound annual growth rate in social grants of 9.5% when we've got such a thin tax base and an economy that's not growing. That's certainly the ugly. But I believe we've got Bonang Mahale back on the line. Bonang, I may have saved you there with a bit of the ugly. We're doing a bit of the good, the bad and the ugly from this GDP figure, and unfortunately you've been left with the ugly. What was the ugly in this number for business?
So first of all, we need to be growing at a minimum of 5% GDP growth to be able to absorb the more than 180,000 young graduates that get onto the job market, often with inappropriate skills. But the way I thought about the ugly is if you look at this and you compare it with the Minister of Finance budget statement, and you go back and say, but what were we expecting during the medium-term budget policy statement? So there's a bit of growth, but it's pedestrian. The debt has increased. The SOEs have deteriorated. So the ratios are now worse. We are now talking about a 4.8% budget deficit, half of the growth estimate that we were thinking of. And people talk about maybe a little bit of an improved tax buoyancy, but the tax morality has actually gone down. That refund has been at the value of about 30 billion because they were held back. Personal tax is now 40% of the basket, up from 30. So you can see that you and I, ordinary consumers, are really suffering. But also there's a clear shift in fiscal policy where for the first time we have breached the expenditure ceiling and now sitting at 16 billion, but also for the first time we are now dipping into our reserves and indeed the contingency plan. So for me, you can see that I think moving forward, all of us need to tighten our belts. It's going to get harder before it gets better. We are eternally grateful for the new dawn that has just set in.
We are, but it's a long-ish new dawn. When we recall the president saying that 3% growth is possible in 2018, I think the market and even the most optimistic probably looked at that and thought, well, there's a little bit too much from the structural issue, from the politics, from everything else to get right. But we have seen positive movements. I think it would be churlish not to point out the fact that we've seen changes at SOEs. We are seeing changes at SARS. We are seeing Shamia Batoli given a mandate at the MPA to be free, fair, fierce and independent. The thing is, what do you think Moody's will make of all of this? Bonang, let's start with you and I'll end off with Maarten and with Kevin on this. What do you think Moody's is going to make of this GDP number? Do you think they'll give us the benefit of the doubt?
I think they might, because there's a general uplift in the mood. Let's remind ourselves that rating agencies are looking for four things. So they are looking for economic, fiscal, and institutional strength. And then lastly, they are looking at susceptibility to major risk events. So when I conclude, of course, they will have a look at it and take a view, because what drives share price is rumor and speculation, sentiment. What we know for sure is that the South Africans are paying more, not just in higher excise duties. We still have about 140 billion uncollected taxes. Now our interest bill alone has breached 200 billion per annum mark, and indeed it is much higher than the nominal GDP growth, and Eskom remains our biggest contingent liability. Thank you, sir.
Contingent liabilities. Kevin, that was another thing from your presentation. Contingent liabilities average annual growth of 13.5% since 2009. Clearly unsustainable. What do you think Moody's is going to make of this?
Michael, I think from a growth perspective, these numbers have to be very disappointing for all the rating agencies. The guideline that they would use is that the growth has to at least exceed the population growth. And right now we're not doing that. And so under those circumstances, you would expect income per capita to fall. You would expect social tension to rise, social grant payments to rise. That's not an environment that would be encouraging, certainly for Moody's. I think they're, though, going to focus on obviously the Eskom story and whether we're doing enough there. And they'll obviously focus on the budget. There was further fiscal slippage in the budget, but probably not enough immediately to tip us into below investment grade. So my sense is, given the stated intention from government, particularly the President and the Minister of Finance, I suspect Moody's will give us more time, in other words, beyond the next review, which I think is the end of March, to see if we can put some of these plans in action that we've promised. And if we can't, then by the end of the year, we look very vulnerable for a downgrade from Moody's. So I don't think we've got time on our side. I think for the moment they leave us alone, but the risks are building.
The risks certainly are building. On the 29th of March, the same day as Brexit, we might face our own Brexit from the global bond market. Maarten, that said, though, and to get your thoughts on Moody's, there is still some margin of safety. If you look at it, South African sovereign debt is already priced as though we're fully sub-investment grade, if you look at the likes of where Brazil and Russia are. So there's a bit of margin of safety. But still, what do you think Moody's might do?
Yeah, I think it's very important. We're on a very, very fine line. All the numbers are actually flashing red. If you look at the deficit, if you look at the debt to GDP. So if there's any misstep from, let's say, Eskom not getting the results that we're hoping for, then, it's a guarantee that we're going to be downgraded. So yes, the getting growth going is very important. The 0.8 is historical. That's last year's numbers. That partly contributed to the tough budget we've seen a couple of weeks ago. So I do think that Moody's will look at all the policy communication that came through the budget and some of the turnaround we've seen even in this number, like the manufacturing that we've mentioned, to give us the benefit of the doubt to say, well, will it be possible this year to get to the 1.5 that they budgeted? If we can, then the fiscal framework can be achievable. So I think for now, talking about March, we're probably safe. Maybe change of the outlook to negative. But if we don't get our ducks in a row before October and then before the next review at the end of the year, it's a very fine line. I think that risk is increasing by the day. You're right to say that a lot of that's already priced in. So I think the impact on markets in terms of the currency or the bonds is not going to be as severe as about 2 years ago if we at that point in time have been downgraded. We've seen a lot of foreigners already leaving the bond market, not only for SA reasons but also for global emerging market reasons. So the financial impact will still be severe, but probably less so compared to if we had been downgraded 2 years ago.
The good, the bad and the ugly from today's GDP number with Citadel's chief economist Maarten Ackerman, Bonang Mahale, CEO of Business Leadership South Africa, and Kevin Lings, chief economist at Standard.